hard truth about real estate investing. Most people don't buy their first investment property. Most people hold back. Why? Because they think they don't have enough money. But what if I told you that money is actually not a barrier? In this video, I am going to show you 6 proven money strategies that will help you turn your dream of owning an investment property into a reality. In fact, I've used a combination of these strategies to build my own portfolio. And in the next few minutes, I am going to break this down for you so you can do exactly the same. The first money strategy is a home equity line of credit. That is a HELOC. What is a HELOC? A HELOC is a flexible credit facility that allows you to tap into the equity of your home and to use the money as you need it. Let's look at an example. Let's say that you have a primary residence that is worth $700,000. And let's say that you currently have a first mortgage on this property with a lender, and that first mortgage is at $500,000. Here in Canada, you can access equity up to 80% of the value of a property. So if we run the math, take 80% multiplied by the value of 700,000 and subtract the first mortgage of 500,000, that leaves us with $60,000. That is the amount of money that you can hold from this property under a HELOC. And the beauty about a home equity line of credit is that on the day of closing, when you set it up, you are not getting this money in cash. So you're not paying principal and interest payment on this money. It's not sitting in a bank account for you where you're actually paying principal and interest. Instead, imagine it like a credit card. You basically have a card that has a limit of $60,000, and you can use this money in whatever capacity you want. You can use $5,000, you can use $1, you can use $10,000, or you can use the entire $60,000 if you want to. And you only pay interest on this money as you use it. So if you use, let's say, $20,000 out of this line of credit, and let's say the interest rate on this line of credit is 5%, okay? Then every month you are paying about $83 on this $20,000 that you've used. You pay as you go. Now, there are some disadvantages of using a secured line of credit, and let me tell you what they are. Because this is a interest rate that changes, it's actually like a variable rate mortgage. If the interest rates go up, then your payment for whatever amount of money you've used would also go up. So you have to make sure that if you're going to use this money to buy a rental property, that you have done 2 things. One, you've accounted for the payment of the money you've used in your calculation, in your cash flow calculation for the investment property that you're buying. And then 2, you've also stress tested the numbers, meaning if you're getting this today at an interest rate of 5%, I want you to stress test the numbers at a higher interest rate at 7%. What happens if the rate goes up to 7%? You want to make sure that you can afford it, and you want to make sure that the property cash flow will also cover for it. I love secured line of credits because they give me flexibility. They don't cost anything per month, and you can use some or all of it. There is a product on the street called Advanceable Line of Credit. And the benefit of that program is that it's dynamic. You've got exactly the same line of credit that we talked about, but what tends to happen with an advanceable HELOC or an advanceable line of credit is as you make payments on this mortgage every month, okay, the limit on this line of credit increases. So let's say the payment on this $500,000 mortgage is $2,000 a month, all right? What happens is if half of this payment is going towards the mortgage principal pay down, and that's $1,000, then this line of credit limit would increase by $1,000. So fast forward 12 months, if you've paid, let's say, $24,000 of mortgage payments on your mortgage, and half of that is going towards paying down the principal on that mortgage, then that line of credit limit would increase by $12,000. And you don't need to requalify to actually tap into that increase, but every financial institution has its own rules on how you can access this money. If you're wondering who offers a HELOC these days in Canada, well, they're offered by the big 6 banks. Some credit unions offer them as well, and advanceable lines are also offered by the big 6 banks as well as some credit unions. So that is actually my most favorite funding strategy as a source of money for a first investment property. Strategy number 2 for buying your first investment property, that is cash. If you have cash in a saving account, in a checking account, TFSA accounts, or a cash that you can extract from liquidating some liquid investments, then that is an option to utilize as part or for all of the down payment. Now, there are pros and cons to using cash. Let's talk about the benefits first. The benefit of using cash is that you have no interest payment on that cash. There is no borrowing involved. And as a result, that can help improve the cash flow on your rental property because there is no monthly payment to account for on that cash. The downside of using cash are actually a couple of things. Number one, cash is king, and having cash at hand as a buffer and as a reserve is always a positive thing. I don't like it when clients extract all of the cash they have from an account and tie it down to an asset. You always have to have some reserves. So that is a downside. The other downside is opportunity cost. Maybe that cash is better utilized in an alternative investment opportunity that can yield you better returns than putting it into real estate. That's an opportunity cost. The third downside is that lenders actually like it when they see that you've got some cash in a bank account, that you've got some buffer, that you're not using cash to the last dollar to put it into an investment property. That actually strengthens your situation. So when it comes to cash, we have to take all of these things into consideration to see if it's the best use of that money. The third money strategy that you can use to fund the down payment and closing costs or both for your first investment property is an unsecured line of credit. What is an unsecured line of credit? An unsecured line of credit works in a similar fashion to a credit card. You get approved for a certain amount and you can use up to that full amount, and you only pay interest on the amount of money that you use. The key difference between an unsecured line of credit and a secured line of credit is that this one does not require a property. You can go to a bank and apply for an unsecured line of credit based on your personal income and based on your credit. Where with a secured line of credit, the bank or the lender needs a property to attach to that line of credit. The benefits are, again, you're only paying interest on the amount of money that you use. No property is required to qualify. But the downside is the following. Number one, the interest rate on an unsecured line of credit could be 2 to 3% higher than what you would get on a secured line of credit. That's number one. Number two, the limit is lower because the bank feels more comfortable giving you more money that is attached to a property versus money that is not attached to anything. So the limits tend to be lower. Also, because you're paying higher interest on an unsecured line of credit, that will likely impact your cash flow on an income property and will impact that profitability. So it is important for you to account for that as part of your cash flow analysis, and also to make sure that you've stress tested the numbers, that you are running the math on higher interest, because with unsecured line of credits, the interest rate also fluctuates as the Bank of Canada changes interest rates. Lastly, when you're using unsecured line of credits, the lenders tend to account for a higher payment in their calculation. What does this really mean? It means that depending on how your personal financial situation looks like, this can impact how much mortgage you qualify for. Because the lenders take a higher payment into their calculations, that could cut down the amount of mortgage you qualify for. But it is a tool that is available to you. You can utilize it in some capacity to augment a down payment or to cover closing costs, or both. And I've seen also investors utilize this tool in particular for renovations. If they need renovations money, this is a great tool for renovations money. The fourth money strategy for funding your first investment property is joint ventures. What are joint ventures? Joint ventures is a setup where you partner with other people and you come together to basically buy a property together. This is actually a strategy that I personally used when I purchased my first investment property. I was working in a 9-to-5 job, and I was so passionate about real estate investing. I taught myself where to find opportunities. I joined investment clubs to learn as much as I can. And I also figured out which market to focus on. Back then it was Barrie, Ontario. And what happened is I had a primary residence, and my plan was to pull a home equity line of credit from my primary residence, but I did not have enough to put the full 20% down and to cover the closing costs. So what I did is I set up a joint venture. I approached a colleague who was working with me at the time, and she was interested in real estate, but she did not have the time to learn and to look after properties and all of that. So what I did is I approached her and I suggested that she contributes the remaining down payment and closing costs to purchase a property together, and for her to also inject a cash reserve into the account. And I took on finding the property, making sure that I screen the tenants, manage the tenants, give her, performance reports every quarter. I took on the responsibilities of what you can call an asset manager. And we've come together to do this deal. I offered to give her 70% of the return, and I took 30% of the return. And we agreed to commit to this venture for a period of 7 years. Now, what are the benefits of a joint venture? Obviously, you are bringing people together to augment, your resources. You may have the skills, they may have the money. You may have the skills, they may have the credit and the money, and so forth. So that's the beauty about a joint venture. Now, the downside about a joint venture, obviously, it's a relationship, and you have to manage that relationship properly. And I really cannot emphasize enough how important it is for you to consult with a lawyer that knows how to put together joint venture agreements and have them put an agreement together for you that would outline the terms of the relationship, who's doing what happens in the worst case situation, which is, someone wanting out before the end of the term, or someone, God forbid, dies or goes bankrupt or divorces. You want to make sure that your agreement captures the what ifs and not the things that we all get excited about, okay? So it is more complicated in that sense, that there is a relationship and you have to incur some extra legal fees, but they're completely worth your time and money to put together. And it's important also to talk to a mortgage advisor early on if you're planning on bringing a joint venture partner to the mortgage application, because things have to be looked at early on before you actually get to the offer stage. But I've personally used this strategy to enter the Canadian real estate investment market because I did not have enough capital back then to make it happen. It's a great strategy as long as you protect yourself and you protect your investor. The fifth money strategy for funding your first investment property is a VTB. What is a VTB? A VTB is a vendor take-back mortgage. This is one of my most favorite creative financing strategies for buying real estate. And it is a strategy that works when the markets are slow, when the sellers are motivated to sell. And I've seen it done on both commercial and residential properties. So how does it exactly work? Well, essentially what happens is you're asking the seller to give you a mortgage to buy the property from the seller. And the seller can give you a big mortgage or a small mortgage. They can also give you a mortgage in a first position or in a second position. It's really all negotiable depending on what you're looking for and depending on how motivated that seller is. So let's go through an example so I can demonstrate to you how to use this tool. And we're going to talk about the benefits and the disadvantages. So let's say you are looking to buy a $600,000 property. That's what you agreed to buy this property for, all right? And let's say that this seller is motivated to sell this property to you. And in your negotiation, in your purchase and sales agreement, you want to get a vendor take back. Well, if you were to go and apply for a mortgage on a $600,000 residential income property in Canada, you're going to need 20% down, and that is $120,000. Let's say that you have $60,000 out of that $120,000 from your own money or HELOC or other resources, but now you're short the remaining $60,000. So what you can do is you can ask the seller to give you a VTB for that amount. So essentially, you are coming up with your own 10%, and the seller is giving you the other 10%, and that makes up the 20% needed to close this property for down payment. Now, you're gonna need a first mortgage, and there are a couple of ways to do this, depending on how you personally qualify. Some lenders are okay with you having a vendor take back behind their first mortgage, and some lenders are not. So we have to be selective of who we're going to fund this first mortgage with. Not all banks or all lenders are okay with this setup on a residential property, but it is doable. Okay, so we can go get a traditional first mortgage, you put your 10% down, and that remaining amount comes from the seller. That is one way to do it. The other way to do it is to say, you know what, forget about a first mortgage from a bank. I only have 10% and I want to make my life easier. All right, I'm going to see if this seller is going to give me 90% vendor take back. So essentially what they're doing here is they're giving you a first mortgage, right? And you're putting your 10% into the deal. That's the second setup. The third setup that I have seen is the following. I have seen clients put nothing into the deal, as in zero. They have nothing into the deal, all right? And I'm gonna talk again about the pros and cons of this, but you can go get a private first mortgage, let's say at 70% of the $600,000, and you can negotiate with the seller to give you a vendor take-back mortgage for the remaining 30%. Which path do you take? Depends on how motivated the seller is, what terms are you able to negotiate for yourself to make sure that the deal works, right? And then thirdly, what's your exit strategy? At the end of the day, a vendor take-back mortgage is a temporary loan that you're getting to be able to pick up that deal. And that loan is can range from 6 months to a year to 2 years, but it will eventually have to be paid off, okay? So all of these factors play into how you're going to structure it. And the beauty about vendor takebacks is that it's all negotiable. I've seen clients negotiate vendor takebacks with a balloon payment, so they're not paying interest every month, but they're making a big lump sum payment at the end of the quarter, or every 6 months, or at the end of the year. I've seen that. The interest is also negotiable. It's what you negotiate with the seller. The downsides, as I mentioned, temporary strategy. You have to speak with a qualified mortgage advisor who understands creative financing, who understands income property financing, to guide you upfront on how you're going to pay this money back. Because the worst thing that can happen is that you get super excited about getting a vendor takeback and putting the least amount into a deal. And then fast forward, when that vendor take-back mortgage is up for renewal, that seller doesn't want to renew for you, and nobody else wants to come and take their position. So we have to think upfront on how are we going to get you out of that mortgage? Are we going to refinance this property? Are you going to do any work to this property to increase its value so that we can eventually refinance it and pay this out? These are the things that you have to think about. But vendor take-back mortgages is one of the creative strategies that real estate investors use, whether they're sophisticated or starting out, as long as you can negotiate. Money strategy number 6, as a source of down payment or closing costs or both for buying your first investment property, is private money. What is private money? Private money is a source of capital that you can obtain by working with a mortgage broker in Canada, or by borrowing the money privately through your network. This source of money is not available through the banks or the alternative lenders. And private money typically comes in short-term loans. It could be for 3 months or 6 months or a year or maybe 2 years. The benefit of private money is that it is fast. It's typically light on documentation and paper to qualify for it. But on the downside, it's the most expensive type of money. Interest rates, on a private loan can go up to 13-14%. And there are also additional costs that you have to account for when you are looking for private money. The lenders charge a fee. The broker charges a fee. And it is a place to shop for money if you're going to buy a property to, let's say, renovate. Because if you use this money on a long-term hold, it's going to eat up into your cash flow. But if you're using it as a temporary stepping stone to acquire a property that you're going to improve its condition and maybe flip, or you're going to improve its condition and increase the value, and you're going to refinance it and pay off that money, then that type of money for a short time period could work for you. Now, here is how it's set up. It could be set up in multiple ways. If you currently have an existing property and let's say you have a first mortgage on that property, and you know that you can't get any more money on this property, maybe because the maximum loan that you have currently in place is 80% of the value, or because you don't qualify with the lenders, but you know that you've got some trapped equity in this property. A mortgage broker can help you extract some of that money through a private loan, and then you can take this money and put it into your first investment property in terms of down payment and closing costs. That is one way to do it. The other way to do it is to do it on the purchase itself. So if you're buying an investment property and you want help with a second mortgage to close that deal, typically lenders can lend you money in second position. So let's say you need 20% down payment, okay, a private lender may be willing to give you 10% of that, okay? And then we have to go get you a first mortgage here, and then the remainder of the money will have to come from your own resources. That is one way to do it. The other way to do it is if there is somebody within your network that is willing to, that knows you well and is comfortable with what you're doing, they may be willing to lend you the full 20%. But if you do it this way, you really have to be cautious, because that lender that is giving you this 20% using their private money is taking a very high risk position to lend you the money. So they have to be very comfortable with what you're investing in and how you're going to pay them back. Also, if you go get the full 20% on the property you're buying using private money, the traditional lenders will not give you a first mortgage because they want to see that you have some skin in the game. So we will have to likely close with another private loan, but then the numbers start to add up, right? Because these loans are expensive. I would never recommend that somebody closes on a property fully with private money unless they have a clear exit strategy, unless it's short term, because again, that money is expensive and it adds up pretty quickly, and it tends to be short-term loans. And once the renewals are up, these lenders want out. So this is a last resort, but I wanted to show it to you because there is a place for it as a real estate investor. These are the 6 proven money strategies that you can utilize towards the down payment of your first investment property. The first one is utilizing a secured line of credit against your home or a property that you own. The second one is using cash. The third one is applying for and using an unsecured line of credit. The fourth one is forming and utilizing joint venture partnerships. The fifth one is negotiating a vendor take-back mortgage with the seller. And lastly, private money. You can use a combination of these strategies, but how to use them and which ones are best for you really depends on your personal risk tolerance, the type of property that you're buying, and your investment strategy. If you're looking to connect the dots to figure out what money tools are available to you and how to put it all together, our qualified income property financing advisors at Streetwise Mortgages can help you. They will guide you. They will give you clarity on the best money tools available to you and how to put it all together. You can book a 30 minutes complimentary planning session at info@streetwisemortgages.com.